Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, the market climbed a little higher again this week with two particularly good days on Tuesday and Friday, when the market spiked higher on good earnings news and the ever-increasing valuation of the oil industry because of the hike in oil prices. There's still a tussle out there, though, between the bulls and the bears. A lot of people have sold and have gone from the market in the last couple of weeks, and a lot of people have bought in with renewed interest. It's been very difficult for the market to be predicted from really one day to the next at the moment, and the Nasdaq has had some wild days where the Nasdaq Composite Index has swung 60 to 70 points within one day's trading. If the Federal Reserve does cut rates this week coming and indicates that rate cutting may be on the cards really up till Christmas, then of course there's a very good chance that the market will continue to climb. Let's now take a look at the Nasdaq Composite Index chart and get an overview of the various scenarios.
12-month chart now for the Nasdaq Composite Index, because I really want to show you the movement over this last 12 months with regard to the long-term average line here. As you can see, back in July we had what we thought may have been the top of the market for the time being, formed here with the big drop away on the concerns for the credit markets. And in fact we did have a panic day back in August when we in fact touched under the 2,400 level at 2,380 approximately, with a quick rebound. What is significant though is the volume action around this period. Excuse me. We have really two things to look at. The typical build-up that you would expect at a sell-off point here. More importantly, when there was a short recovery in the early part of August, that's when the volume reached its peak. Not so much at the buying point, but at the first opportunity to sell at a reasonable price off the top. Now that's significant to us, particularly when it's reinforced by the fact that when the rebound did come on the news that the Federal Reserve was going to most probably cut rates and support the market to some degree, we did get the inevitable increase in volume on that day and the day after, but it was very short-lived. And notice how the volume has dropped away dramatically at this point here. These 2 points are significant, and even though the rebound has been really more than we expected and has in fact gone on to create a new high, it's done it on relatively low volume. The volume is starting to build again near this new possible top. We're well extended now off of the long-term average line, which is again a point to note. And all in all, we feel that this may again be another top forming and not just a continual trend further upwards. If I draw the long-term trend line, which really came from this point here, here we go, drawing it through there and not at the base of the panic action, but really at the base of the action over that 2 or 3 days, which is really that point, you'll see that the trend line now is showing that the new high formed on Friday with the rather good jobs report and the readjusted August figures has really reached a point well above the long-term trend line and ripe for profit taking and at least a short-term reversal at this point.
Many analysts are beginning to look at the action over the last week to 10 days as a flag that's formed after the climb from the mid-August low. We agree that this could be a flag that has formed, which means that the market could well take off now again next week. This is likely to happen, of course, if the Federal Reserve does go ahead and cut another 25 basis points this week, as is widely expected. And then we do feel that there is a strong likelihood that the market will creep up a little further. particularly if the Fed policy statement goes as far as to say that further rate cuts could be on the cards for the next few months. We're not totally convinced, however, that even the promise of further rate cuts will really push this market much further up. There's still the overhang of the credit market situation, the weakness in the US housing markets, the extreme weakness now of the US dollar against a basket of world currencies, and of course just the simple fact that this bull market has gone on for 5 years now, and in particular the last few months have seen quite a rapid rise, and is showing signs of tiredness. We do feel that the market is still climbing a wall of fear, particularly now with the lofty heights of the price of oil, which is now hitting new highs of $93 a barrel. This upcoming week will certainly help to give us a better indication of where the market is likely to go before Christmas. So until next week's summary, it's goodbye from London.